Hi, ladies and gentlemen, Chris Weston here. I'm joined today as I go for a sort of a whistle-stop tour through the UK with Michael Brown from TraderX. I thought it'd be a good idea just to have a little bit of a tap into his mind, have a bit of a loose conversation about what's going on in global markets. If you've got any questions, leave them in the question box below. Smash the like button if you can. But it's a good idea just to go through the sort of crazy world of markets with Mr. Mikey Brown and see what's going on. So first of all, Michael, welcome to the programme.
Well, welcome to London.
Welcome to London. It's good to be back in Blighty. Sun's out, guns out. But look, I think ties off today. So I'm taking you down to my poor standards, looking a bit shabby. But look, it's good. I think we'll probably start with sentiment in global markets at the moment. You know, we've seen a break on the S&P of 4,300 and it's just continued to climb up. The Fed have been about as hawkish as we probably could have got. But markets resilient continues to be the case. I mean, I'm looking at the VIX at 14%. The VIX term structure is still very flat. Credit spreads, you've got high yield credit spreads around 406 at the moment. They're still pretty contained. Breadth has started to improve. Everyone was talking about 7 stocks in the S&P being... the realisation of what's been going on. But breadth started to increase now. Banks are holding in quite well, certainly in the US. How are you seeing broad sentiment at the moment? And where do you see, look, we'll take equities in a second, but how do you see, where's the pain trade at the moment?
Well, I think the pain trade is still higher equities. I mean, the market, you've had so much, not just bearish commentary, but bearish positioning, all this bad news. And stocks have just shrugged it off.
Yeah.
There's still a lot of cash sitting on the sidelines that needs to be allocated into the equity market. We're going into summer, which is a quiet spell anyway, with the VIX at its lowest since Feb 2020. That's only going to come lower, you would expect, unless there's some sort of black swan event that we can't foresee. Yeah. And I think thus far, and as you said, we'll get onto the Fed in a second, but Jay Powell last night, pretty much as hawkish as you can get in a presser. Dot's going 50 basis points higher, and the market's just gone, we don't believe you. So,
what do you think about this idea that global central bank balance sheets, the big four, have actually increased this year? I know quantitative tightening has been happening, and the balance sheet has been sort of buoyed up by the Bank of Japan, who continue to buy everything under the sun. We've had that momentary blip where the Fed increased its balance sheet through supporting of the banks. But the balance sheet should start now running off a little bit. Do you think that's going to matter for markets? Do you think it's going to be...
I mean, it's one of those things. Everyone loves to use liquidity as an excuse to get bearish. We all know that. And the Fed are going to continue running down their balance sheet. You'd expect the ECB to increase the pace of their runoff as well. Yeah. But the question you've got to ask yourself is, one, is that going to be outweighed by the BOJ, who show no sign of easing up anytime soon? No. And China are coming out with almost a stimulus package a day at this moment in time, it seems. They cut the lending rate again overnight by 10 basis points. So if you're going to have more liquidity and stimulus coming out of China, does that outweigh the negative effect from what the Fed are doing? And I'd argue it probably does at this point.
Yeah, no, I'm agreeing. I think we're going to start seeing global central bank balance sheets start to come off. And there's a big focus on the Treasury issuance that's coming forward. Is this going to be, supported ultimately by the reverse repo program, or is it going to be done on the liquidity side, reserves? We don't know yet. I suspect it's going to, I personally sit in the camp, it's going to be more bank reserves that are going to come out. But right now, the market looks pretty resilient. And I think it takes us into a point of where central banks are, right? So the Fed have come out, they obviously didn't raise rates. It was well telegraphed. The market was pricing in about 3 basis points.
That we shouldn't call
the skip. That's right. But look, they've told us that they want to continue to, core PCE needs to come lower. Their core PCE revision was, what's it, 4.1%. You ask yourself, well, why they actually just didn't do the Bank of Canada and RBA and actually raise rates? And I know they're very different from the RBA and the Bank of Canada. Powell wants to be very preemptive. He doesn't want to surprise markets. Yeah. And to his credit, he did exactly that.
He actually, sorry to jump in, he actually said that at the presser last night. He said, that he was asked a question that basically the Fed don't surprise markets anymore. And he said, well, we don't really want to. We want to telegraph what we're doing as well as we can to make sure things are as smooth as we can when we're tightening policy.
But they basically went as hard as they possibly could have gone. Yeah. Without raising rates. And you ask yourself why they just didn't do it. They might as well just raise rates, because now what you've got is they raised the dot plot to 5.6%, with 9 of the 18 voting members also calling for 2 rate hikes this year. And you've got to say we've got 4 meetings left. It's a pretty punchy and aggressive timetable to go around doing it. The market hasn't bought it though. Like, it's interesting because if you have a look at US OIS, if you look at the swaps market, what we're pricing a terminal price of 5.3%. So there's about a 30-point difference, basis point difference between the medium dot plot projection for this year and where the market's pricing the terminal peak pricing for this year. So the market's not buying it. Maybe when we get the next CPI print, which I think comes out in mid February, mid July, and then the payrolls number, which comes out on the 7th of July. Maybe then they'll say, well, a bit more, because we've got about 16 basis points being priced in for the next meeting as well.
I think the market's almost as data dependent as the Fed at this point. You know, the Fed have said, we're going to wait and see what the data says. That's why they've skipped. And I agree. I'm not sure they're going to learn much in 6 weeks that they don't already know. Yeah. But the Fed are saying we're going to wait for the data. We're going to see what the data says. If inflation is still...
Well, they weren't data dependent for the meeting we just had.
Well,
because the data suggests they should have just risen. But, okay, I want to switch tacks because like, we talked about the Fed and the market showing, you know, not quite sharing the dot plots at this stage. And I think if you look at the market reaction in the dollar, bit of dollar strength, but it's not been outrageous. Yeah. A little bit of selling in the front end, the treasury curve, and equities have held in pretty well. They're saying, okay, we live in the future and maybe we've priced in that situation. Or maybe they're saying, you can raise rates again. We don't think it's going to cause that significant gyrations. I want to go into the motherland, into the UK, because that's really interesting at the moment.
Do we have to do this?
We've got the Bank of England, arguably the most aggressive rate central bank in the market pricing from this point. And you know, you've got some economists who are saying that we could get 6% bank rates. The market's not quite buying that at the moment. We've got 29 basis points of tightening being priced in for the next Bank of England meeting on the 22nd. So that gives you, a 25 basis point hike and a little bit of a premium. I guess the first question we've got with the Bank of England is, I just don't see a world right now where we're going to see a step up to 50 basis point increments. Do you?
No, absolutely not. I mean, you've got to think, and I think actually Powell, again, going back to his press conference last night, sort of spoke for every central bank when he was saying that, 2022, when we were seeing 50, 75 basis point hikes, that was almost catching up with inflation that was running away from them. Now it's not about the speed, it's about the level that you get to.
Yeah.
And I think you're right. The BOE they're struggling to muster enough votes to get 25 at the minute. So they're not going to get anywhere near getting 50. I think the question is really what happens first. The BOE are going to keep hiking. And it's really a question of, pricing the terminal bank rate is basically saying, when do you think the economy is really going to turn south? Because as soon as you start to see the housing market soften and as soon as you start to see GDP growth and some of those leading indicators like the PMIs really start to fall off, particularly in the services sector, the old lady's just going to go 25 basis points a month. And probably we get to Q3 and they go, well, we can't anymore because we're breaking the economy. It simply can't sustain it anymore.
Yeah, I think with 25 basis point increments, going forward until something economically sort of starts breaking. CPI could change that. And if it comes in super, super hot, maybe the market says, we need to. But I think that we're not going to get a 50 basis point hike in the next meeting. Maybe it comes in the July meeting, but we'd have to have a very super hot CPI number and they'd have to change their guidance to prepare us. And then, we've got
there's a lot of ground to cover.
We've got 36 basis points of tightening being priced in for the July meeting. So the market is saying, we've hedged that kind of risk that they could move to a 50 basis point step. But I think the barriers are pretty high. I want to touch on the RBA because we've just seen a ridiculously hot employment number. The employment number was one of the reasons the market said in the April data series that they should have held rates at the last meeting. And now it's come in with 75,000 net jobs being created. The market's pricing 16 basis points of tights for the next RBA meeting. So they're saying on balance, we're more likely than not to get a rate hike. And, we've got the cash rate potentially going up another 30, 40 basis points into the terminal. I think things are starting to look pretty precarious in Australia in terms of business confidence, consumer confidence. But yeah, the RBA want to see the housing data start to really cool before starting coming down in that situation. But the Australian dollar looks pretty good, certainly against the yen at the moment.
Yeah, I think there's some interesting parallels actually you can draw between what the RBA are thinking of and what the BOE are thinking of. Because if you look at the economies, they're very, very sensitive to rate shocks, particularly from a housing point of view.
Yeah.
I mean, here in the UK, and you'll probably know the Aussie numbers better than me, but I think there's something like 2 million mortgages that are fixed at below 2.5%. That have got to be remortgaged.
We've done a lot. We've done a lot of the fiscal adjustment and the mortgage adjustment, but there's still quite a bit to come, and it's still going to work its way through the system. So I think households, are starting to do it tough at the moment. Yeah. But I think the RBA will continue to tread this. I think they've got this mantra of a path of least regret.
Yeah.
So the last meeting they could have paused, but they said, we think inflation's still too hot, so why just keep the pedal to the metal.
And also, Philip Lowe's off. He's going in September. He's not going to get another term, is he? So what's he got to lose? As you say, at least regret.
I think we've got to think about fiscal as well. But I want to touch on the ECB quickly before we move on. We got the actually saying this just before the ECB meeting, so it's probably something we should revisit. They're going to raise 25 basis points, and I guess we're going to be looking at the economic projections. I guess the other point as well is this idea that we've got this huge amount, 530 billion euros of PEP loans, which still need to come off the bank's balance sheet back to the ECB, and how that's going to be addressed, because that could cause some duress to bank funding costs and various factors. But the ECB will raise 25 basis points and give a pretty strong indication that they're going to raise further. And maybe that pause or that indication of pause comes in a future meeting, July, maybe September.
Yeah, I think it's probably July for the ECB when they pause. That will be 3.75% on the deposit rate, and you're actually already seeing both headline and core inflation in the Eurozone come lower, plus the block's in a recession, which is going to be playing on policymakers' minds as well. And then I think the ECB gets really nerdy and geeky from September onwards, and we start talking about balance sheets and telltales again, which will be all fun and games that we know and love.
Okay, I want to talk about stocks, because we talked about about various central banks where they are, but there's a huge amount of resilience in the equity market. And as we've seen all year, I mean, you come into the year and people were very pessimistic on tech, and which is probably why we're where we are at the moment. I mean, we've seen 13 straight days of gains in Tesla. It couldn't make a 14th. Tesla.
That's because you wrote an article.
Well, I realised that. It was hot, and I was suggesting that I think short selling Tesla has been a tough way. It has been a brutal trade, to be honest. But the market's seeing that as an AI stock now, rather than an auto stock, because of the demand for NVIDIA's chips and its data centers to program itself and test its models for the autonomous side, but also they're creating these sort of centralized computers now, like iPhones, which take these NVIDIA chips in, and they have these updates every now and again. And your whole car is built around this computer, and this is something Renault's doing.
You're basically driving a computer now. You're not driving a car.
It is, and that's right. So you can have these iOS updates, or whatever the equivalent is in the car. And you can just get these increased performance without having to go to a mechanic or a garage and having new parts being put in. So it's a really interesting world. But Tesla's now been very much treated in the whole sort of AI scene, which of course has been so hot with AMD, NVIDIA, IBM. I think was up 22 out of 24 days as well. But I'm looking at the Nasdaq, which has sort of been on an absolute tear. I've been looking at the Nikkei, which we still like further at higher. I mean, the Nikkei's been. I mean, a lot of that's down to the yen weakness, and obviously, if you price the Japanese market in dollar terms, it's less strong. But we've seen huge inflows into Japanese markets this year. Earnings have been better. Dividends have increased about 14%. Warren Buffett in April coming out and saying that Berkshire Hathaway wanted to buy Japanese stocks. It was good enough for him. It's probably good enough for the market.
I think the other thing, sorry to jump in with Japan, is if you want exposure to Asia, no one wants to touch China at the minute. So where do you go? You go to Japan.
Well, China's an interesting one. So I think the Hang Seng and Chinese markets, they're moving higher.
Yeah.
We've got the Hang Seng looking like it wants to go and test 20,000. Stimulus has obviously been a big part of that. But I think we've hit peak pessimism on China. We've been talking for a while about the data being underwhelming. The reopening trade, which a lot of people were positioned for in January and February, that's fizzled out pretty clearly, and they're having to stimulate because we are coming into a year on base effects as well. Remember, Shanghai reopened in June, so we're getting to a point where now the base effects from that will impact economics negatively as well. So they need to they need to stimulate more, and they have been. They've been doing stuff on the EV front to increase purchases. They've been doing stuff on home sales, because new home sales have been very sluggish, and they've been doing various factors to incentivize demand effectively, and more is going to have to happen. We've seen reserve ratio requirements will probably be the next thing that needs to be cut. And I think that China equities look good, but we're seing a grind in price. We're so used to the Chinese market
surge higher,
these impulsive, explosive moves, and it's been a sort of gradual grind. An interesting one, though, I think, you go into European markets, we've got the DAX now at the top end of its range. I think it breaks out personally.
Italy as well. Italy's looking good.
So I think, for me, I'm still staying fairly constructive on equities at the moment. One that we would look at very closely is the US 2000, the Russell, effectively. That we'd like to see that doing a little bit better. But for now, we're still staying. I still prefer to be long than short.
Oh, most definitely. I mean, I think as we touched on earlier, with volatility as low as it is, and the market shrugging off pretty much everything that the Fed and data can throw at it, it is tough to make a bear case for stocks at this point. In all honesty.
I want to touch on the FX markets because, we talked about central bank policy. We're still fairly constructive on equities at the moment. But right now, we saw the dollar index, looking like it wanted to make a test to the top end of the range, and it sort of rolled back a little bit recently. We've dropped about nearly 2% in the Dixie. We tried to rally after the Fed meeting, but it's been pretty unimpressive, to be honest. So if I'm looking around G10, I'm taking a modestly negative bias on the dollar index. But I like the dollar against the Japanese yen. I still like the pound for my sins.
Oh no! So this is where we're going to disagree.
Well, I just said it's just doing all the right things at the moment. But for me, the trade at the moment continues to be carry. Some of the LATAM currencies look pretty good. The yen just looks repulsive. Keep selling the yen, in my opinion. I can't get excited about the dollar. I think if my stock, I'd get more concerned around my constructive view on equities. If the dollar started moving up, and again, it always comes down to the rate of change, isn't it? But if the dollar started getting a wriggle up, and we started seeing front end yields on twos pushing towards 5%, we're at 470 odd at the moment. Then I think equities could make a turn. But I think the dollar is really key here.
I think the thing for the dollar is, does the market actually start to price this 50 basis point revision in the dot plot? If we do, you're going to see front end rates move higher, OIS is going to move higher, and you'd expect the dollar to rally along with that. But I think the reaction to the Fed last night was quite telling, because you had that. It was only about even 50, 60 pip move in the dollar higher. And then it faded almost by the time Powell had finished his opening remarks at the presser. It just couldn't hold on to the gains. I think that's quite worrying if you're a dollar bull. But then at the same time, I kind of look around the market. You go, you don't want to buy the yen because it's a shambles.
No.
I can't bring myself. I know you are, but I can't bring myself to be bullish on sterling. I think the market is seeing it as a rate play. It's seeing it as a carry play, but we're not going to get to 6%. So you'd think that's got to be priced out at some point. So then you're thinking, do you really want to buy the euro? Do you want to buy something like the Aussie or the CAD? You maybe look to some of those higher beta currencies, which are a bit of a proxy with risk assets. That might be where you venture.
I think you make a good point. Look, growth is really key now. And we're going to be looking at relative growth plays. So we've been trading this sort of interest rate dynamic, but I think it now comes down to the idea that central banks are going to raise the terminal pricing, and then it's who's going to continue to growing at the best without the economics. So we're going to start trading. We're going to be very sensitive to relative economic changes and look at surprise economic differences and bits and pieces. And if the Bank of Japan were then suddenly to change its policy in the later meetings, I think that could be a major change to volatility in the FX market. So for now, I still like the relative interest rate differential play, but I think they'll get to a point when we get to those terminal pricing where we start saying with higher for longer, which economies are going to start cracking the most.
Who can actually withstand.
And I think that's where you're going to see currency market people will trade those flows. So it's an interesting one. I want to go into gold, obviously the most traded product at Pepperstone. Where's your sort of short-term bias on gold?
Well, so gold I see as a yield play. effectively. I mean, there's a few factors that drive gold. Obviously, risk appetite. Risk appetite is very, very strong at the moment. I think gold is simply a play on yields. If you do see yields move higher, gold is going to move lower as a result. And if you see yields move lower, gold should rally. I think the one thing I would say is it's interesting how we've got to this 2050, 2075 level, I think 3 times now. And every time we've got there, we've just backed away very, very rapidly indeed. So you could argue we're going to be stuck in a bit of a range for some time to come. But I don't have a particular bias on precious metals as a whole.
I think it consolidates, and I think it's holding in really well now. But what it's done is we bought gold as a hedge against a downturn in economics, lower credit creation. Everyone's, March people focus on the banks. We bought gold because people were pricing in a significant amount of rate cuts this year and certainly more into 2024. And that was a hedge. People were hedging against economic fragility, led by the banks cutting back on credit. Now, those rate cuts have come fully out of the market. We're pretty much a flat situation, and rightly so. But that's where gold becomes interesting now, because those rate cuts have come out, gold's held in. I think if we were to see a downturn in economics, which of course the Fed would love to see, and I think jobless claims are really important, does that start seeing lower payrolls, then gold will start to trend more positively. Because what we've done is we've moved down from 2070 down to these 1930 odd at the moment. As those rate cuts have come out of the markets, gold's come down as they hedge. If we start saying, right, we're now looking at the US is going to go into recession, that to me is when you start seeing gold back in its form at the moment. Right now, there's not a huge need for gold in the portfolio. You can have it as a protection, but that trend of recessionary risk won't happen overnight. It will take a trend in the data, and when you start seeing that, gold will start trending. So the time is not now. You can trade it intraday, obviously, and people do, but to see actually a strong, impulsive, bullish trend, we need to see economic fragility and the chance of a US recession early 2024 pick up, and I think people start buying gold.
And I think the thing on economic fragility, and just going back to what we were saying about higher for longer, again, Powell said last night, and all central banks have said it, they want the labour market to weaken. They want slack. They want below trend growth. So this is not going to be a case of 2018, 2019 when the US economy started to soften and the Fed started delivering those insurance rate cuts. This is actually now going to be a case of, if you see the data soften, if you see some slack coming into the labour market, central banks are going to be going, great, this is what we want. This gives us an excuse to leave rates where they are. It shows our policy is working. They're not just going to ride to the rescue with the sort of QE fire hose once again.
So what's the data point that we need to watch above everything else then? I'm going with the jobless claims. I still think that, we saw 261 last week. Will they come up? We're just about to see them coming out today. So sorry if people are watching this and you've got the data. But you want to see jobless claims trend higher, because that will give us that's your leading indicator on the labour market. If the Fed want to see slack coming into the labour market, which is going to reduce the wage pressure, that's going to be the thing that they say, we're pretty happy about. And that's going to be something similar in the UK. Obviously, wage growth is very strong. We're concerned about wages in Australia, although it's not a major issue. But I think labour markets, if they were to start cracking, given that they're such a laggard, would be the reason we'd start saying, we need to maybe, we're certainly going to go on a higher for longer pause. And if they got really problematic, it would give some of these central banks the need in next year to take a very restricted policy setting back down towards a neutral setting.
Exactly. I think for me, it's jobs, it's housing, and it's leading economic indicators. You look at things like goods orders, the PMI surveys, that sort of thing, really just trying to gauge, to what degree is the economy softening, and that will dictate how long we leave rates at their terminal levels in this very, very restrictive territory. Okay,
before we go, number one trade. I'm gonna continue right now, and I like to be nimble. As CFD traders, we don't tend to have longer term views, but right now I still think the right trade is to continue selling the yen. We're still at a situation where we're sort of getting towards the tail end of it, but central banks are still raising rates. They've still got this kind of path of least regret, and they're still, when they're thinking about things, the economics are still improving. The data's coming in hot relative to expectations. Inflation surprises are coming in reasonably hot maybe not in the Fed, but we've got core PCE at the end of this month, and that's something that come in. And on balance right now, you've got that yield differential. So I still like selling the yen. We've got big breakouts in Aussie yen, which Aussie yen's been in beast mode, isn't it? We've just seen a breakout in dollar yen, driven by front 2-year treasury. So I still like selling the yen, to be honest, and using any kind of strength to I think that to me seems like a crowded but obvious trade.
I think everyone knows what I'm going to say. Sell the pound.
Okay.
Short cable. It yes, we're at what 126.40, 127-ish. But if you look at what that rally is based on, it's based on, as we said, rates getting somewhere near 6%. I see very, very little chance that the BOE are going to get anywhere near that. And let's call a spade a spade. The UK is in stagflation at this point. We've got very, very high core inflation, is at a 30-year high. That's showing absolutely no sign of slowing down. We're in the very, very early stage of what looks like a wage price spiral. And growth, GDP growth, hasn't been above about 0.2% on a monthly basis for the last 18 months. And higher rates are only going to make that problem worse. And I think the BOE are going to fail to live up to the market's expectations. So actually, I wouldn't just be selling cable. I think sterling is lower across the board.
Okay, it's an interesting one. Taking a view at the moment that still relatively constructive on equity markets, and certainly Japan's well worth seeing further upside, in my opinion, in the Hang Seng. Balance of risk still favoured higher in the S&P, although we are coming to a point where we just still need to be very nimble and look at your risk. Taking a pretty neutral view on the dollar, apart from against the Japanese yen. Michael's obviously very bearish on the pound there, as we've been seeing. And we are still continuing to watch that interest rate pricing across the G10 central banks as well. If you've got any questions, do leave a question below in the comments field. Hit the like button if you stayed on watching this long. Obviously, we're doing something right. And it's been a pleasure today to talk to Michael Brown and to you guys as well for watching as well. So thanks very much.
No, good stuff as always. Thank you, mate.
Cheers.